Hello, everyone. Okay, evening, everyone. Okay, if you're joining us on the session today, drop a note, say hi. We are down to day 16 of our Project Options Cashflow for the entire month of June. Okay, welcome and thank you for joining us in this evening's session. Okay, all right, the mic is on, it's working. Hi, Uncle Fu. Hi, Said. Hi, Josephine. Okay, hi, Muru. Okay, great. Hi, Anthony. Okay, we just wait for more to stream in and join us in a couple of minutes. All right, pardon for the slight delay. I'm on bedtime stories duty today, so got dragged a little bit behind over here to start off tonight's session. Okay, so someone's saying you can't see. All right, let me check. Okay, we're good to go. Now, so once again, welcome to all for joining me in tonight's day 16 of Project Options Cashflow. And I hope all of you have brought a stock along with you, okay? Because I'm gonna pick three, all right? So let's do three of you tonight, okay? So give me your stocks and we'll plan out a trade that you can build a portfolio on, okay, with one of your favorite stock over here, yeah? Right, so tonight's session is a little bit more focused on the practical side of the application. Right, so the best way over here is really to go into some of the stocks that you guys are looking at, okay, and then we could go together and pick some put options to be selling and building a portfolio around it for the couple of months ahead of us. Okay, Kane, yes, the video is working. You might just have to refresh your Facebook page over here, all right, to see the video again, yeah, all right. Okay, now, so let's get today's session started. Okay, Uncle Fu, all right, EPD, all right, we'll have a look at it later on. Okay, we'll look at what trades we could do, okay? All right, so those of you who have a stock in mind, all right, just post it up in the group over in the comments over here, and we'll have a look at it after that. Okay, all right, so we look at Uncle Fu's EPD, all right, and then two more. Okay, all right, we'll look at two more from the next two comments over here, okay, in terms of stock symbol. Okay, all right, so welcome to I'm Possible Investors Project Options Cashflow for the entire month of June. So we are going to carry this out for the entire month of June over a 30 days period. And our job over here is to really bring light to investors' attention in terms of options as a financial instrument, okay, options as an investment tool and investment product, and why common investors should really have a look at it in terms of using it to build a long-term cash flowing portfolio for themselves. All right, if that's something they really want to do. Okay, so today we're going to do a quick test. All right, can you build a portfolio that drives income in less than 5 minutes over here? Yeah, okay, and produce better returns than what you could get from the basic commercial markets. Yeah, okay, so that's the main focus that we have for today's session. Now, again, if you have not joined us in our new Telegram group, okay, the QR code is at the bottom of the screen. Okay, so please do join the Cashflow with Impossible Terrence Telegram group. Okay, and today our stock lingo for the day is really risk-free rate of return. Okay, all right, now, so that's pretty much the return of investment with zero risk over a specified period. I think the name kind of explains itself. It's self-explanatory. Okay, but if you need more clarifications, go to our Telegram group. Okay, and join it so you'll be kept updated over here. Okay, okay, so we got three stocks today. Okay, we have Uncle Fu. all right, with EPD, all right, we have James with FCX, and we have Javon with WBA. Okay, now, so we'll go have a look at them and then take a look at what kind of safety we could get around these stocks and what kind of income and cash flows we could generate from them as well. Okay, right now, so keep that in mind, and we'll be making use of these stocks later during the practical session of this period. Okay, right now, so standard disclaimer over here: investing carries a risk of loss, so any trades being discussed today is purely for educational purposes. So if you're going to go ahead with the trades, okay, if you're within our community, of course, you will know what to do. Okay, if you're not amongst us in our community, then do weigh out your own risks and make sure you understand what you're doing before going ahead to do so. Okay, now same thing as well as yesterday. Okay, if you've joined us and you have not done so yet, okay, do make sure you click the share button, all right, because we will be providing a summary again for tonight's topic, which is selling ridiculous puts and building a portfolio doing so. Okay, we'll be sharing the summary sheet with the downloadable link, okay, on the shared posts from those of you who have done so. Okay, so if you're not help us do so over here, click on the share button, right? So we'll be able to reach out to as many investors out there who are thinking about investing and growing their money amidst the difficult periods that we have amongst us in 2020. Okay, now, so what lies in the benefits? Okay, where lies the benefits of today's strategy? Today we're going into the Portfolio Builder series. Okay, so today we're talking about Portfolio Builder series of strategies. Pardon the error, it's not day 15, it should be day 16 now. Okay, so day 16, we're selling naked puts or what we call ridiculous puts. Okay, now, so where lies the benefits? How do you use this strategy? Who is this for, right? Okay, I'm going to take away the rest over here because I'm going to focus on trade application immediately. Now, so let's revise a little bit when it comes to selling put options. Okay, so this was covered on day 12. Okay, day 12. Okay, so day 12, we covered the idea of selling put options from a trading perspective. Okay, today we'll cover it from a portfolio building perspective. Okay, so sellers of put options, what we do is we make a promise and we make a commitment, okay, to our customers. Let me bring out the pen, right? So we make a commitment to our customers that we're going to buy their stocks. Now, so the whole idea of building a portfolio in the stock market is really about buying stocks as well. But of course, the key, like some value investors will tell you, is to go out there and make sure you buy value stocks, okay, or stocks that Mr. Buffett will approve of. Okay, all right, now, but there are many ways to comprehend this statement over here. So value stocks could be, metrics that Mr. Buffett follows. It could be also growth stocks that you see potential in the growth of price. It could also be dividend stocks for the sake of income. So everybody has different priorities, and build a portfolio that caters to your needs and really suit your needs. Okay, all right, now, so the whole idea is to take advantage of, right, sellers of put options where some typos going on over here. All right, give me a minute. All right, I need to change this up, okay, to make sure there's no misunderstanding. All right. Okay, now, so let me make sure my screen share is up. Yep, Javon, I just noticed that. All right, thank you very much. Okay, all right, so just for the benefit of everyone over here, sorry for the error over here, day 15, it should be day 16. Okay, so we're selling naked puts or what we call it as ridiculous puts over here. So we're going into the Portfolio Builder series, as we mentioned earlier. Now, so today our focus is really going to be on being a seller of naked puts, but we are going to achieve what we call a portfolio building effect from this particular strategy. Now, so this strategy brings about what we call a potential obligation to buy stocks. So as I said earlier, it could be stocks that you really want to own. So what happens then is the obligation to you as the seller, right, becomes something that is acceptable, something that you could accept, because people go to the stock market to look to buy good companies at undervalued prices or good companies at reasonable prices. Now, so selling put options allow you to dictate that price okay, purely because, all right, you get to determine the agreed price, or what we call the strike price for the put option. Okay, and that price is going to be what the obligation to buy the stock is going to be done at. And you also get to set your own timeline. Okay, and for doing so, you get to collect cash up front. Okay, now, and your view is really simply this: you just don't want to crash. Okay, you don't want the market to crash. Okay, all right. Now, so break even before losses. Okay, now, so there's also what we call break even before losses start to incur over here, because as option sellers, you get to collect premiums for the sale. Right, so there's already money in your pocket from the very beginning. So, even if the stock goes below your strike price, you're still pretty much fine. Now, so because we're going to talk about this on a portfolio basis, so your objective of the strategy is really, you got to pick out a stock that you're bullish for the long term. Okay, you don't just want it to be bullish for the short term in terms of a technical perspective, but you really want a stock that you're willing to own for a really long time to come. Okay, now, so if you want to sell put options and build a portfolio, this should be the basis of how you choose your stocks. Okay, all right. Now, so what is your dream price to own the stock? That's the next criteria that you need to have in your mind over here. So you start selling ridiculous puts over here when you're hopeful, right? So you may have heard, during this COVID crisis, sometime in the month of March, many people have, really made some great income selling, what we call these ridiculous puts during those periods. Because if we presume, options, or specifically put options, as insurance policies in the stock market, all right, so, during a crisis or after a major market crash, this strategy could also be seen as the stock market giving or throwing out free cash, right, to people who know how to execute this strategy right. Okay, even in our community, we have done a couple of examples of this, and, many of my seasoned students, or the more experienced ones, right, would have used the same strategy on many, many different stocks, right, and created, thousands of dollars during this period. Okay, now, so if you'd like to find out how to do so, right, do stay tuned to today's session, right, and we could find out some ideas that could still play out in the current markets. Okay, now, so let me get to this over here. Okay, great. Now, so John, if I'm lagging over here on Facebook or something, maybe you could refresh the Facebook page itself, right? Because Facebook at times over here do lag due to algorithms and stuff like that. And on my end, it seems to be fine. Yeah, all right, it seems to be fine. Okay, all right. Now, once again, if you have not done so, okay, but you've just joined us, do make sure you click on the share button on the video, and we'll be posting the downloadable link for the summary sheet of how do you sell ridiculous naked puts over here at the end of the session on the shared post for those of you who have done so. Okay, all right. Now, so do help us by helping others over here, and let others know that we are discussing a fantastic strategy today and how they can make use of such a wonderful strategy as well. Okay, all right, now, so let's take a quick example over here, all right? What does it mean, all right, when we are talking about selling ridiculous puts? Okay, now, so let's say we take an example with Wells Fargo as a stock today, okay? Now, so if you're looking at Wells Fargo, okay, let me bring out my drawing tool. Okay, great. Now, so if you're looking at Wells Fargo, now, so if Wells Fargo was trading at, oops, okay, it's finally out. Now, so if we have Wells Fargo trading at 24.44, okay, all right. Now, so what we could do over here is first we pick out an expiry date. So let's say, we are pretty laid back. All we want to do is to generate more than average returns in the long run or year to year. Then our money that is kept in the bank, be it a fixed deposit, be it in unit trust, all right, we want to manage these capitals on our own, but we don't want to dedicate too much time into doing so as well, right? How do you pick out great stocks? Okay, that's one of the things we covered in IMP, right? And our community members as well, right? They get a whole basket of stocks, that fits their criteria, and they do not go in blind, and they know why and exactly why these stocks that we're looking at right, their stock prices are going to compound and keep going higher and higher for years to come. Okay, now that's of course the element of what we call great stocks over here to be investing in. Okay, now you could do it from a fundamental perspective, or you could do it from our way of analyzing it, right? Where we have it easy, we create it easy so people can understand and they can buy into companies, feeling very assured that they're going to make money at the end of the day. Now, so if we have Wells Fargo over here at 24.44, right, we could actually go out to 21st August 2020, right? We could pick out a 1750, right, put option, right, 1750 put option, right, and the market was actually willing to pay up to 55 cents, right, for this option over here, right? Now, so what it means over here is this: if you're willing to own 100 shares, okay, so that means today, if you're thinking about buying 100 shares of this company called Wells Fargo, you have two choices, all right, to play this stock. One, of course, is just simply to go and pay that money, okay, and buy the stock outright. Okay, that means you pay today's market price, okay, and then you're gonna buy 100 shares of Wells Fargo. Okay, or the other way, right, is to do what we call making low ball offers. Okay, by making low ball offers, what you do is you sell a 1750 put option, right, on Wells Fargo, right, and the market will pay you 56 cents for it, which is effectively $56 upfront. Okay, while what you're effectively doing is you're waiting. Okay, so effectively what the market is doing when you sell a put option, right, it's you're waiting, right, to buy that stock. Okay, but you're not waiting to buy the stock at today's prices. You're waiting to buy the stock at the strike price that you've determined over here, which is 1750. Now, so come expiry date over here, two things can happen, right? The stock is at 24.44 today. Okay, your commitment over here to buy the stock, okay, is at 1750, right? Which means anything above 1750 has nothing to do with you, okay? And nobody is going to give you the stock anyway, right? Nobody in the right frame of mind is going to sell you their stock at 1750, right, if it's worth anywhere more than that. Okay, right now, so if nobody wants to sell those stocks to you, that means the option is going to expire worthless, and the $56 is all yours to keep. Effectively, what you've done is you've sold an insurance policy that nobody has made a claim on. So the premiums you collected are all yours to keep scot-free. Okay, now, so you can always redo this all over again and collect another set of income, right now, and keep doing this repeatedly over here before one day. Of course, there's always going to be that one day when the market finally crashes and you end up buying a stock. Okay, but that would be fine because you are ending up buying the stock at a price that you're totally happy with. Okay, so make sure one of the criteria over here is to choose a strike price that you're happy owning that stock at. Okay, now if you're not happy owning the stock at that price, you're better off going off onto the next stock on your list that gives you the chance and the opportunity to get it at the price that you want. Okay, right now, so our break-even price on this trade is going to be 1750 minus 56 cents. So that puts our break-even over here at 1694. Right now, if we actually buy the stock, right, that will be our cost basis as well. Okay, now, so imagine this one day. Okay, you repeatedly did this for a couple of times. Let's say you collected this put option over here, you sold it, and you collected 56 cents, and you did this for like 10 times. Okay, so what you have done is you have collected $5.60 in income, right, by selling put options on Wells Fargo. Okay, and then on the 11th time over here, right, you have collected another 56 cents. Okay, you put it into the kitty, right, and then somebody makes you buy the stock at 1750. Okay, now can you imagine what's the cost basis of your stock at that point of time? Right, it's going to be 1750 minus 560 minus another 56 cents on top of that. All right, so your stock would have cost you somewhere around $11 over by the time you actually own those stocks. Now, so if you get to buy Wells Fargo over here, one of the biggest banks in America, right, and you believe that it's too big to fail basically, right now, and you can buy it at $11 a share, I think that's not too bad a deal after all. Okay, not too bad, in fact, to hold it for the long term, right? And perhaps, we have another bull run over here and you see the stock going to $30, $40, $50, right? You might think about cashing out if you want to, right, at that point of time. Yeah, right. So this portfolio is going to be one of the simplest one that you can think of building, all right, and yet it offers you an edge, right? An edge where you are allowed to buy below market value prices. Okay, you don't have to wait for the market to come to your price, okay, but you get to dictate the terms, right? And you get paid to wait to buy it at that price. Now, so you may have heard of articles saying that Mr. Buffett is one of the biggest sellers of put options. Sorry, that's the opening bell. Right now, so you may have heard Warren Buffett is one of the biggest sellers of put options. Right now, this is exactly why he's doing so, because he's probably identified some company where he's willing to take a really, really huge stake in the company. But unfortunately, the current trading price is actually much higher than what he's willing to pay. So he may actually end up going to the markets and selling some puts while waiting, all right, for the stock price to drop to his value, right? And he actually gets paid to do so as well. Okay, now that may ultimately be something that he does, but on a bigger scale of things, to make sure that the market is big enough to accept his quantity and his size, he does this more often than not on the indexes over here, right? So he believes that the entire US market index, right, yes, it may correct, but in the long run, you just keep going higher and higher. So after a crash, it's going to recover as well. So what he does is typically he sells what we call 2 years to 3 years put options on the indexes, right? So he's not anywhere worried even if the market crashes, because he has time on his side. Yeah, right. Time for the market to recover. Right. That's basically it. Now, so we have this margin for error, which is where the stock price currently is, right, all the way to 1694. Right. So you can imagine over here, right, that it's actually pretty ridiculous. Okay, it's pretty ridiculous because now if the stock were to drop to 1750, okay, let's just take the strike price over here. For 24.44 minus 17.5, that's a fall of rounded up $7. Okay, $7. Right now, if you take $7 divided by 24.44, right, you're looking at what we call a 28% drop, right, of Wells Fargo price from where it currently is. Okay, now, and when I did this example over here, I'm already taking into account, right, the crash of the stock market after COVID crisis over here. Right now, so imagine this, all right, during COVID, a lot of financial stocks have dropped by 50% and more, right, and yet we're challenging the stock right now to drop another further 28%, right, and if it doesn't do so, I'll pocket the 56 cents, I'll look for another put option to sell and collect another set of income again. Okay, now, so let's look at the 3 scenarios over here. Okay, now, so if you find this information useful as well, all right, make sure you get your hands on the summary sheet that we have prepared, all right, that sums up all the key ideas that we'll be discussing today. So how do you get your hands on it? All right, all you have to do is to click on the share button on the Facebook post. Make sure you share the videos out, all right, and do make sure that your profile, all right, your Facebook profile allows me to, see that shared post over here. So I'm able to paste the downloadable link on the comment itself. Yeah, okay, all right, because if I don't have access to that post, that means I can't leave you a comment over here, right? So I hope you understand that, right? So do make sure you set your settings profile in terms of privacy, right? And share the video out, okay? Now, so this is the 3 scenarios that can happen over here. So we have the stock sitting at 24.44, which is where it is today. So if the stock stays where it is, it just bounces around. So the option will expire, all right? And we make about 15.7% in 3 months over here. Right, we keep the 56 cents profits. Now, if the stock goes up, of course, if you bought the stock, you would have made $5.56 on the stock. Okay, but here we are only going to make 56 cents. Right, so this is the disadvantage over here, where we have a limited profit scenario, which is the premiums we collected as sellers of the put option. Okay, now, so we're still going to end up with the 15.7%, right? And then if the stock goes down, let's say it goes down to 15 over here, all right, I would end up making a loss of 194 if I'm going to sell off the share, or if I'm going to close off the put option. Or alternatively, I could just decide I'm going to build a portfolio around this. I'm going to accumulate this share, so I'm going to buy the share at 1750. All right, and then I'm just going to sit and wait on it. All right, anyway, most US banks at the moment, they do pay dividends on stocks ownership. All right, so while you're waiting for the share price to go up, right, you have already collected some premiums and you're still going to get paid dividends as you wait for the stock price to go up. Yeah, right. So if you're really looking at a really laid back passive form of investing for a passive source of income, right? This is definitely one of the strategy you want to look at. Of course, you could say, Terence, then I could just go out there outright, okay, and buy dividend paying stocks, right? Because I can start the stream immediately, right? But have a look at this. Most dividends are probably like 50 cents a quarter, or 30 cents a quarter, or 70 cents a quarter, right? Most of the time you'll be able to sell a put option that pays you that amount or even more, right, in the same 3 months over here, right? So many people actually tout selling put options as a form of going out there and create your own dividends on stocks. Okay, so this means that you can get paid even on stocks who don't officially declare a dividend, right? So for example, if you're hot on one of the tech unicorns out there right now, for example, let's say Slack, right? We'll have a look at Slack later. Okay, now Slack obviously doesn't pay dividends because it's still trying to grow its company and its business, right? So by selling put options, you are actually creating your own dividends because you're getting paid. All right, you're getting paid for a commitment to buy the stock. It may not happen, which is what you really want. You don't want it to happen, right? So you can keep recurringly do this over and over again, right? But if it does happen, you're perfectly fine with it, right? Because you believe in the company, you're fine with the fundamentals of the company, right? I hope all this makes sense. All right, now is this clear so far? All right, if it's clear so far, can you just leave a comment over here? All right, clear. And I know that everyone is following suit. All right, great. Okay, now, so I do understand we have some lag from where I'm streaming and of course Facebook's algorithm. So at times you see me sitting around while waiting for some of the comments to come out over here. Yeah, right now that's perfectly fine. Now, great. Okay, now so great. Everyone's clear so far. All right. So let me go ahead. Let me continue, because we could go through a lot of things over here today. Okay. Oh, sorry, John. I just reread your comments. Sorry, John. All right. So you're saying that, all right, the voice is really good over here on Facebook. All right. Thank you very much. All right. Okay, great. Now, it may be the mic I'm using after all. All right. So, okay. Kudos to technology, basically. Now, so let's get to the platform. Okay. So let's get to the platform right now. Right, as well, John, I've not seen you for a while. I hope you're doing fine and everything is going well. Yeah. Okay. All right. Now, so let's have a look at what's on star today. So let's begin with the Wells Fargo strategy. Right, the Wells Fargo stock that we mentioned earlier. Right now, so you should be seeing Wells Fargo prices on my screen right now. Right, so what will make a good strategy on Wells Fargo is actually pretty simple, right? Imagine this, okay? The Wells Fargo was trading around $50 at the beginning of this year, all right? And then it started to crumble because of some company scandals, all right? And some practices which were not above board, right? And then after that, with COVID, it just got slammed, right? So it got slammed from $50 all the way down to a low of 22. Right, it got to a low of 22 before, during the COVID crisis, before it kind of rebounded after that. Okay, all right, now, so that was the 14th of May. All right, that's a special day for me. All right, the 14th of May. All right, so that's exactly the date where Wells Fargo hit rock bottom. Right, and that price happens to be around $22. Now, so imagine this. Imagine if I give you an opportunity today, right, to acquire Wells Fargo shares. Right, and let's just assuming you have checked the fundamentals, everything's fine, everything checks out. Okay, now, so if I give you an opportunity to buy Wells Fargo at $22, for example, okay, all right, now, would you be happy doing so? Okay, now, so if you can accept that, okay, if you can accept that, the only thing that's left to do over here, right, is to go check out, all right, how much you can get paid, right? So let's say we look at an October expiry. So let's look at an October expiry option for Wells Fargo, right? And 22.50, right? There's a strike available for 22.50 put options, okay? And it's actually paying, it's not very liquid, but let's take a last done price as our reference. Okay, it's actually paying up to 120, which is the last done price, right? If you want to sell this put option. Okay, right now, so if you wish to sell it, okay, you are accepting the fact that you get to buy Wells Fargo at the bottom of what COVID did, okay, or near the rock bottom of what COVID did for the stock, okay, and if it doesn't do so, you get to keep 120 over here for the next 3, 6, 9, 12, 4 months. Okay, you get to keep this for the next 4 months. Okay, what's your liability? Your liability is you may have to prepare, right, $22,250 to acquire 100 of these shares. Okay, now, the technical term for this strategy in the market is also called cash secured puts. Okay, so if you hear anyone going about telling you cash secured puts, this is effectively what they're doing. They're selling put options, but they have the cash ready to pick up the stock. Okay, now, so when you do a strategy like that, effectively you've got no risk at all because the entire risk is down to the stock going bankrupt. And you have already decided that based on your fundamental choices and selection, you have picked a stock where you're never ever going to see it go bankrupt, then you pretty much avoided the risk to begin with. This is the same exact reasons why people choose to, load up the truck only on blue chip stocks, right? With the same philosophy, really, because many would say and tell you they, could not fathom or see the fact that, any blue chip companies or stocks in whichever countries they are in, right, could ever go bankrupt. Okay, now, so this is the same scenario over here. Now, so what kind of returns will you be looking at, okay, if you actually did this? Okay, first, if you pocket 120 over here on capital or preparation of capital, which is to pick up the stock, which is 22.50, right, let's take a look. 120 divided by 22.50, all right, you're making about 5.3%. All right, that's a return of 5.3% in 4 months. Now, imagine this, come 4 months later, October, right, the option expires and you don't have to buy the stock. You walk away scot-free, making 5% returns. Okay, of course, the stock may have gone up even further, which means if you bought the stock, you have made a bigger return, but this was 5% that's scot-free, which means at that point of time, you could return and sell an identical opportunity over here, all right, and make this 5% all over again for another 4 months. Now, so if you do this for 4, 8, 12, 3 times a year, all right, so if you make this return of 5.33% for 3 times a year, just by simply repeating it 4 months at a time, right, you're actually going to end up with almost a 16% return. Right now, and many of us would know 16% return over here, right? It's actually a very decent return, okay, when it comes to portfolios. Okay, now, of course, you're not looking at those 100% returns over here because you're not buying the stock, you're not, taking on those risks, right? You're trying to pick up stocks at a heavily discounted price, right? You didn't get to do so, but you still made 16% on your portfolio. I think you couldn't really complain over here. Yeah, okay. Now, so that's the opportunity that you're looking at. Now, so let's look at some of the scenarios that you brought up. Okay, so Uncle Fu suggested EPD. Okay, so let's take a look at EPD over here. So EPD, if I'm not wrong, it's a gas royalty company. All right, okay, it's a gas royalty company. All right, so I know they pay dividends, but I'm unsure if they pay dividends on a monthly basis. Okay, all right, I'm not too sure if I remember that correctly or wrongly. Okay, now, so the next dividend date is due on 29th of April. That's outdated. All right, so I'm not sure if they cut the dividends. We may have to do a check on that. Okay, all right, great. All right, Uncle Fu, thanks for the details over here. All right, okay, great. That's pretty good. All right, now, so which means, okay, this is Uncle Fu over here clearly stating one of the reasons why, he's perfectly fine with holding and keeping a company like that. If you buy the stock at today's prices, right, you're pocketing a yield that's almost 9% upfront, right? It's a company that's continuously paid dividends for 21 years in a row. Okay, all right, now, apart from that, okay, the next important point over here is what's considered a ridiculous put that we can aim for. Okay, now, so looking at the prices over here, we could clearly see, all right, that since the COVID crash over here for the stock, which brought it to a low of $10, it's been on an uptrend over here, right? It's pretty steady, right? It's been a steady uptrend over here, so supported by this, uptrending line, okay, and also the moving averages that you can see on my screen over here. All right, now, so let me zoom this a little bit if I can. Yes. Okay, now, so I would say this is a pretty good price. If you are willing to get in, that will be $16. All right, the next one will be over here, $15. And of course, the rock bottom over here will be 12. Okay, all right, so we have 16, we have 15, and we have 12. Yes, so let's take a look at different scenarios over here. Okay, now, so let's say if you're trying to be really passive and you just want to do it once every 3 months. So if 3 months is your goal, we could look at the September expiry. Okay, now, so one thing about options is you could only sell what the market makes available to you. Okay, so you realize Wells Fargo had October's expiry, okay, but EPD only has September and then followed by December expiry. So you have to take a pick. It's either going to be 3 months, and if it's not 3 months, then you have to go all the way to 6 months over here. Okay, now, so if you want 3 months then, all right, something that's not too long, right, you could look at the 16 strike, which you could probably get 70 cents today for it. Okay, so if you do that, 70 cents for $16 to be ready to buy the stock, or 1,600 for 100 shares. Okay, so 0.7 divided by $16 per share, that's pretty decent. That's 4.4%. I'm going to round it up. 4.4% for 3 months over here, right? So you multiply this by 4 times a year, it's still going to bring about a 17.5% return for one entire year. Okay, for one entire year. Okay, and at that strike price, you're looking at a discount of 20%. That means for you to have to commit to buying the share, right, EPD shares have to drop by 20% from today's price levels. Okay, it's to drop by 20% before you have to fulfill your obligation. So do you think 20% as a safety buffer is good enough? If you're not happy, go further, because we said 15 was equally good as well. Okay, so if you do 15 over here, all right, that means 15 divided by 19.8. All right, then you have almost a 24% safety buffer. All right, that means your margin for safety is 24% from the current stock price. Okay, and you'll be looking at a return. You could aim to get about 55 cents. 55 cents divided by a commitment of $15. So that's about 3.67%, right? 3.67% times 4 times a year, that's 15% per annum. Okay, 20% safety buffer and being able to make 15% per annum, I think, all right, it's a no-brainer over here, as long as you're happy with, consecutively compounding your portfolio at such returns, okay, on some of the great stocks that market makes available to you. Now, look, you really have, a couple of choices over here, right? If you have money right now that you don't really need to touch them for the next 4 years, 5 years, 6 years, right? You could do this in the stock market, right? Now, why do I say so? Because if you're wrong, you may end up owning some of the stocks out there which you deem are the best available to you, right? With the greatest potential. Now, if you believe, right, that the stock market would make great companies' stock prices keep going up over the years, then you're definitely going to get much more appreciation doing this, or better returns doing this, than keeping your money in those banks over here. Yeah. Okay. All right. So it's pretty much a left or a right choice that you're looking at. Yeah. Okay. All right. So great company over here, Uncle Fu. All right. Now, for those of you who are lazier, right, you could even do this outright. You could sell something that goes all the way to January next year. Right, committing to $15, right? But you can see the liquidity is a little bit bad, so it makes it hard to negotiate. Okay, so this is probably not advisable over here. Yeah, okay. This is also not too good. Okay, so the furthest you should go is actually September, right? If you're trading EPD, okay, and thinking about selling put options on EPD. Yeah, okay. The second stock, I can't remember who it was, all right, but I remember the symbol was FCX. Okay. Right, FCX, if I didn't remember wrongly, it's a stock and a company that deals with copper. All right, okay. The person who brought it up can remind me over here, but I believe this is a company that deals with copper, if I didn't remember it wrongly. Okay, James brought it up. Okay, right. So James, correct me if I'm wrong, but I think it has to do with copper. Yeah. All right. Now, so it seems the company has cut their dividends or eliminated their dividends. Yep. All right. Now, so right now the company no longer pays any dividend. Okay, and it's only trading at $10. I've seen this stock before, so I know it significantly crashed. Definitely. Okay, now, so we have the stock trading at around $13, right, before slamming all the way to 5 amidst COVID crisis worries, and then, of course, steadily rebounding upwards right now as well. Okay, right, so we have it now at about $11, and for mining company, all right, there may be a risk of bankruptcy. So we can see now copper and gold, right? So they deal with copper and gold. Okay, now, so I would say even if you're gonna pick any strike, all right, you might want to go $8 and below. Okay, $8 and below. All right, now, so if we do this, let's look at it as well. See, the choices are very limited. You could do this only for 2 months now, right? There isn't even 3 months available, right? So all you have is really 2 months, right? So you look at 2 months expiry or 157 days, 3, 6, 9, 12, 15, 5 months. So you're either looking at 2 months or 5 months over here. Yeah, okay, all right. Now, okay, now, so let's have a look over here, 21st of August. If we look at it, 66 days to expiry. We mentioned and talked about the $8 strike. So there's still some premiums over there. All right, now, so it pays about, you could get it about 23 cents. Okay, so first, your objective, James, you have to be fully comfortable, all right, at owning FCX as a stock, right, in your entire portfolio for $8 a share. Okay, so it's pretty cheap, all right, because for 100 shares, it's only going to cost you $800, all right, and if the company goes bankrupt, that's all you're looking at losing as well, $800. Okay, now, you could sell the $8 put option for 23 cents. Okay, so let's work out the returns. If you do 23 cents divided by $8 in commitment, that's about 2.87% or 2.88% for 2 months. Okay, 2 months. Now, so this means you could do this almost 6 times in a year. All right, so you're still looking at about 17% over here. So you could see, you know, picking out heavily discounted commitment to buying the share prices, all right, you could still eke out anywhere from 15% and higher, all right, on a very simply built portfolio like that as well. Yeah, okay, all right, now, so 17% for an entire year, all right, on FCX over here. Okay, FCX, 23 cents. Okay, 23 cents. Okay, James, all right? If you want to be lazy, let's see if this is possible for this stock, right? And go all the way to January next year. Now, see, liquidity comes in now, right? So this for this stock, if you want to sell it for an entire year, it's also possible. Right, so James, if you just want to be lazy and sell an $8 put option that goes all the way to January next year, right, you could pocket like 75 cents immediately, right, for this sale, right, which is $75, right, $75 in cash flow or income, right, for an option that expires all the way in January, okay, all the way in January, okay, right, so once you sell it, all right, you're happy with the returns, you just sit, okay, and wait for the option to expire or wait for your obligations to kick in. Yeah, all right. Okay, great. Now, hope everyone's following so far. Okay, all right, do me this. Okay, how many of you find today's topic? Okay, how many of you find today's topic of building a portfolio around selling put options? Okay, on stocks that you're willing to own, right? A very interesting topic. That means it's a topic that you'd like to know more about. Okay, now, if this is a topic that you'd like to know more about, all right, can you type yes in the comment section? All right, because I'm thinking of doing something over here, right? But before I make that commitment to doing so, I want to see, you know, if it's something that would benefit those of you who are joining us in this session over here. Okay, because if I want to do something, I want to make sure that it benefits the people who are listening in right now, and also bring, you know, profits and benefits to you. Okay, but if it doesn't, then, you know, I may think of something else instead that could bring more benefits to you. Okay, great. Now, so do me this favor as well. If you have typed yes in the comments and you have not clicked on the share button for this video, all right, do click on the share button for me as well. Okay, because what I'm going to do now is I'm going to make all of you, right, a promise. Okay, a promise. Now, so what I'm going to do is this. Okay, I'm going to cover this particular topic. That means I'm going to take it really simple. Okay, and I'm going to do a once a week session. Okay, picking out a great stock. Okay, once a week session, picking out a great stock. Okay, and discussing what kind of put options we could sell on it. Yeah, okay, that means I'm going to do a live trade once a week. Okay, we're going to have a live trading session with Terrence once a week over here. All right, and we'll cover this concept during that session. Okay, and of course, I'm Possible Investors. You know what to do over here. All right, so if you want to do it the way I've discussed, that's fine. If you want to do it, the way we do it in our community, all right, just adopt the strategy. Okay, and apply it because you should know how to do so. Okay, and then manage it accordingly after that as well. Okay, all right, now, so if all of you find it useful, as I see many of you typing in over here, all right, so what I'm going to do is after the 30 days challenge is over, all right, I'm going to commit to 1 day a week, okay, and we're going to pick one stock over here, and we're going to do a live trade example on it, okay, a live trade example series on it, so we could coin it live trading with Terrence once a week over here. Okay, now, I cannot promise you there's going to be a fixed date because due to calendars over here, there may be clashes of events, okay, that I may be committed to. Okay, so I will do it once a week, but to be able to get notified on the live session, okay, I will need you to be part of our Telegram group. Okay, now, so if you have not scanned the QR code and be part of our Telegram group, make sure you are in the group, okay, to be notified when we launch our first session doing this over here. Okay, and subsequent weekly sessions we will notify it in the Telegram channel. Okay, all right, so do make sure you do so. 1, right, leave a comment yes. Okay, 2, click on the share button for the video, and then 3, make sure you are already inside our Telegram group, okay, to be notified when we're going to launch this and when we are going to do this on which day of the week over here. Okay, all right. Let's move ahead. The last stock that was being brought up, let me run back and have a look over here in the comments. WBA. All right, we'll cover Chris' stock as well, Rost. Okay, all right. So since there's only 4, we'll cover all 4. Okay, now, so WBA is a dispensary, all right, which means in America, it's slightly different from what we have over here. Right, so in Asia, most of us, visit our GPs, visit our doctors, and then, we get our medication from them. Right, so they have the license to dispense medicine to the patients. But in the US, everything is about insurance. Everything is about insuring yourself. So even if they go to see a doctor, the doctor is only going to give them a prescription, and then they're going to take that prescription and go over to a store like Walgreens or CVS or ABC over here to get their prescription filled, right? That means to buy the actual medicine. Okay, so Walgreens is definitely a company that does that. And it also controls right now after an acquisition, Boots Alliance, Boots, right? So Boots, if you travel to Britain or UK very often, you're more familiar, right? Or the nearest ones we'll have it over here will probably be Thailand, right? So Thailand has a lot of Boots outlets as well. And if you've been inside one, you realize, okay, Boots are pretty much functional as Watsons and Guardian stores that we have in Singapore and the rest of Asia. Okay, now, so this stock right now has been beaten down for a little bit, okay, and the dividend return is 4%. Okay, now, so this will be an income stock over here if you're playing it. So let's look, WBA, all right, it's in a downtrend, right? So we could probably draw a trend line over here, which is down this way. Okay, and of course, right now with the recent bounce, obviously we have we have a trend line over here that has been broken on the upside. Okay, a downtrending line which has been broken on the upside. Okay, all right. So if I draw it over here, okay, let me do this right. Let me get the drawing tool. Okay, if I start from here. Okay, connecting all the highs. Okay, so we have the downtrending line over here, all right, and then we have the breakup, all right, and then it came back down, and then now it's trying to attempt to break that again. Okay, now, so if you believe in the fundamentals of the company, which means if there are reasons that you can believe why this company is going to recover and why it's just not going to go bankrupt, okay, then you could take, this $37 low over here as your objective for selling the put option, okay, or to own the stock, okay. Now, so if that's your strike price over here, so let's take a look now. 66 days or 122 days, okay. Now, so let's go 66 days at 37.50. I think it's pretty decent. Yep, that's round about where the last low price actually is. So 37.50 will bring you a premium of somewhere around $1.40, I would say. Okay, $1.40. Okay, so $1.40 on a commitment to buy a stock that is worth 37.50. Okay, now so $1.40 divided by 37.5, right? That makes you 3.7% in 2 months. Okay, so 66 days, so that's around about 2 months over here. So you could do this 6 times a year, right? And brings you 22%. All right, 22%. All right, and 37.50. So let's take a look. 37.50 divided by 42.4. That's a 12%. That's a 12% drop, okay, from the current stock price level. Okay, so if you believe that the stock price will not drop by a further 10% from where it is today, right, then this is a strike that you could look at. Okay, if you want more safety, then you could go with the 35 then. Right, so the 35 will probably pay you about 85 cents. Okay, 85 cents divided by 35. Okay, sorry if my maths is moving fast because I do this all the time. Okay, so that brings you about 2.4% for 2 months. Okay, so if you do this 6 times a year, you're still looking at about 15% rounded up. Okay, so that's 15%. Okay, and 35 will bring you a margin of error of about 18%. Okay, so a 12% margin of safety, or an over 20% return annualized, or a 18% margin of safety with about 15% annualized. Okay, all right, Javon, so this is what you'll be looking at over here. Yeah, right. So again, I can't remember who brought it up, all right, but the stock was Rost. Okay, all right, so Rost. Okay, now, so Ross Stores over here is definitely one of the amazing yet unknown retail stores, okay, that, when I actually found out it was that great itself, right, it was, pretty amazing as well, right? So Ross, if I'm not too wrong, is a discount store that operates in US, right, and they take seconds or factory seconds over here, and then they sell it for a much cheaper price in their stores. But right now, you'll probably only really see it in America. So you might not have even heard of it if you have not traveled to America, recently or, ever before. Now, so Rost over here, let's take a look. So it's fallen together with the COVID crisis because all retail stores are shut. So it fell by 50%, right, all the way down from $120 to $50 before resuming the uptrend together with the markets. Right now, so 96 is where it is right now, and I think the first decent purchase price will be somewhere around 80, all right, 80, right? But if you want to buy it at the lows in March, it's going to be a bit challenging over here. Okay, so $80. So first you have to decide, all right, based on your calculations, is $80 a price you're willing to pay to own a retail store outlet like Ross Stores? Okay, what are the benefits? Ross Stores, effectively, it seems, does not pay any dividends, so I can't really put an argument for that in terms of buying a retail outlet right now. Okay, in this current environment, buying a retail outlet that even does not provide any income sources, which means you really have to keep on top of your fundamentals of the company, right? And if you're not tuned to do that, or you're not trained to do that, it might be a good one to miss at the moment. Okay, it might be a good one to miss at the moment, right? Not because I, want to condemn the stock, right? But we all know the retail impact of the COVID crisis. So come around the next earnings announcement, if it doesn't do as well as expected, or even after the discounted, projections, all right, they still missed it badly over here because of sales. Right, then you could imagine the stock price could literally go back all the way to the bottom over here. all right, and there's no dividends to support the price as well. So I would find it difficult to give this an argument over here. Yeah, okay. All right, now, so because I can't have an argument for it, so in my preference over here, I would rather not look at it as a trade, yeah, or not look at it as a trade. Okay, now how about AMD? Okay, all right. So apologies to the person who raised up raw stores. Okay, but just on the onset of looking at things, this is how I like to do it. I'll do it in a 5-minute analysis. If there's no story, no play to it, then I would much prefer to give it a miss altogether. Okay, now AMD, right? So what's the story of AMD? All right, the story of AMD is, of course, the most recent CEO, right? She seems to be doing a magnificent job right now. They came out with a slew of product which seems to be hot in the market right now. So we're seeing a resurgence. Okay, we're seeing a resurgence. Okay, all right, now, so AMD, if you really want to play the stock, right, I would say you want to look at somewhere around here. All right, so if you believe in the channel that we're in right now, you'll be aiming at least 50. Okay, all right. The minimum puts that you should sell over here should be at least 50. All right, if you want, you could go as low as 40 over here, which would be much safer. All right, so let's take a look. All right, AMD, can you get something for 40 or can you get something for 50? All right, now, so AMD, as you can see, is more liquid. That's why you see weekly options available for the stock, right? But we have to make a difficult choice over here. We either have to choose to sell 30 days options, okay, 30 days expiry options, or if not, then we will have to go all the way to 122 days. Okay, all right, now, so let's go to 122 days. Let's see if we can get 40. Yes, we do, right? And somebody is willing to pay a decent size of money, right, for the 40 strike. Right now, so for 40 strikes, somebody can pay you up to 155, for example. Right, we're just going somewhere in the middle. Right, so 155 for commitment to buy the stock at $40. That's about 3.9%. 3.9% for 4 months. 3, 6, 9, 12, 4 months. Okay, now, so if you do this 3 times a year, it'll bring you about 11.6% return. Right, 11.6% return. Okay. Now, so this is something you can look at, Anthony, with AMD, right? The 40 strike, which gives you a buffer. I think I don't need to calculate this one. $15 away, a 30% margin for safety, right? So if you believe the AMD stock price should not drop by 30% from where it is trading today, right? Then this looks like a decent put option to be selling, all right? Because you've got a huge margin of safety for error over here. Okay, all right, Anthony? I hope that helps. Okay, all right, now, welcome, Anthony. All right, now, so I hope today's session was pretty interesting for all of you. Okay, and likewise, like I just mentioned, for those of you who click on the share button, as well as to join our Telegram group. Okay, we will be notifying you on the first session we're going to arrange for live trading with Terrence, okay, which will cover this as a strategy or the main focus, picking out a good stock, right, and a good put option or ridiculous put option to sell, okay, all right, during those sessions over here. I'll release more details when we have scheduled the first date once the 30 days options cash flow is over, right? So which means we'll probably do this at the beginning of July. Okay, so do stay tuned, and if you have friends over here who've always asked what you're doing as an option seller, or have interest in options over here and selling options specifically, right? Do get them to join you on this journey. Okay, share with them the Project Options Cashflow, right? They could go to our website, okay, and register on our website to get started on the whole entire project all over again. Yeah, okay, they could get started on day one all over again. Yeah, all right, now. So all they have to do is to go to our website, opt in on the Project Options Cashflow over here, right? And then get themselves going. Okay, all right, now, so let me undo this before I get to the summary of the PowerPoints. Okay, all right, so question time, all right, question time before I go to my last slide for today. Okay, anyone with questions, please post them up. We'll answer those questions right now. Okay, so side, if the stock price falls below the sell put strike, the stock will be assigned at what price? How would the broker determine that? Side, as we said earlier, right, the agreed price. Okay, so the transaction of the stock will be done at the put option strike price. Okay, and that was chosen from you right at the beginning of the year. So taking our AMD example, the last stock, if we sold the $40 put option, right, for October expiry, so if you have to buy the stock, okay, Uncle Fu, I'll talk about work, right? Okay, get working, Uncle Fu. I remember that now. Right now. Side, let me answer your question. So for AMD over here, we would have to go with 40. Okay, that means our commitment over here will be to buy the stock at 40. Okay, right? So the commitment to buying the share will always be the put option strike price that you're selling. So for AMD, as you see on my screen, that will be 40 over here. Yeah, okay. Now, so let's go to Slack, right? As Uncle Fu reminded me, get working. Right now, so for Slack, we have the up run over here. I actually bought some stocks on Slack at $20 at the bottom, right? Not too much, just a little bit of it. So I'm just letting it sit and run, right? But if you're looking at getting some right now, definitely the prices will run up, right? So you could look at 25 strike, or you could look at the next low over here, which is 22, right? So I think anywhere from 25 to 22 is pretty decent over here. Now, so let's take a look. Slack is, of course, a new company, right? Or a new company in the stock market. It's a tech unicorn. So 31 days or 66 days, that's your choice. Okay. Now, and seems they pay pretty well, right? So we're saying 25, okay, or 22. Okay, so let's see what strikes we have. We have 25, which pays around 95 cents for 2 months. Okay, and 22, which pays about 40 cents for 2 months. So let's analyze that quickly. All right, welcome, Sai. 95 cents. 95 cents on a commitment of $25 to buy the share. That's 3.8% for 2 months. Okay, 3.8% for 2 months, or 22%, 23% rounded up, annualized, if you do this 6 times a year. Okay, what's the safety buffer? The safety buffer is divided by 31.4. 21% margin of safety from today's prices. That means as long as Slack stock price does not fall by 20%, all right, your put option is safe. All right, your put option is safe. Now, if you want 22, which is something safer, that's 40 cents divided by $22 commitment. That's only going to bring about 1.8% for 2 months. Right, so that's 6% annualized. 6 times annualized, 11%. That's 11% return for a margin of error of 30%. Right, 22% margin of error. Right, over 20% annualized returns, or 30% margin for error, 11% annualized returns. Right, you realize they are all still much better than the long-term returns that you get from financial institutions at the moment, right? So you can really see why selling put options over here is very viable as a as a portfolio building strategy for those of you who just want to keep your portfolio really simple, right? It's not wrong to go on Facebook every day right now and watch some videos and learn more about companies and more about investing, right? But just it's just not everyone's hobby. Right? That's why I always tell my students, all right, if you're going into the stock market because what you want is the outcome, all right, then try to find an approach that fits your lifestyle. Okay, if you find that it's a drag, attending these sessions just to come and listen to what people say about companies or analyzing companies, if you realize you have absolutely no interest in that, right, then today it's the most simplified version of generating better than expected returns from the market. Yeah, all right, okay, Christine, we discussed this yesterday. Right, so the difference between selling put options and selling naked, selling naked and selling spreads. Okay, selling spreads. So the only difference over here is the ability to cap the loss at a maximum level. Okay, so today we are talking about selling put options as a portfolio building strategy. Right, so if anything happens, you're willing to own the stock. Right, so this is what you can look at doing over here. All right, and most of the strikes we discussed today, all right, even giving you as much as 30% margin of safety still pays you over 10% per annum. right? Which means you probably be very likely not obligated to buy those stocks, right? Because it's quite ridiculous, right? This would only happen if a market comes crashing again, right? Which, as we've seen so far, happens once in about every 10 years, or maybe a mini crash, which happens once in every 5 years, okay? Right now, so if you believe in building a portfolio in the stock market, this is something you should really definitely look at. If you want more ideas on this, do join me on my live trading sessions in the month of July when we start launching this as a weekly affair, right? And hopefully we'll be able to bring more benefits to you, yeah, right, during those live trading sessions and live discussions. Okay, welcome, Christine. All right. Okay, last question over here from Zen. Okay, last question from Zen over here. If a stock goes below the strike price before expiry, okay, the option buyer can also exercise the put option. Yes, Zen. Remember, as an option seller, your obligation is set. That means it's cast in stone. And the buyer of the put option has the right to do so any day, right? Which means if you sell a 66 days expiry options, which we are seeing on the screen right now, even if they want to exercise it tomorrow, right, they have every right to do so. Okay, they have every right to do so, right? But you do have to understand the psychology of why would someone actually want to do something like that. Okay, now first, if the customer is buying a put option, right, as a bet on the downside, okay, that means if the stock actually goes down, right, he would have made money trading the options, right? So he could just, liquidate the option trade and make their profits and run. Okay, they don't want to be coming up with capital for the stock, right? And then after that, dumping the stock as an extra step just to realize those profits. They bought an option, they could just sell the option, which is worth much more in market, right? And then walk away with their profits. Okay, now, so the only probably customer of yours who would think about, exercising those options are the ones who have actually bought these put options as protections, all right, or protective measures on stocks they actually own. That means you may have met a customer who actually bought 100 shares of Work or 100 shares of Slack, right, and he's trying to protect his own Slack stocks at $25. So he's going to come to you and buy the $25 put, right? And for that, right, he's got to pay you 95 cents for that. Okay, now, so when do you think, right, this customer would actually want to sell away those shares? Right, he'll probably only want to sell away those shares to you, okay, if he deems, right, there's no longer any more hope on those shares. So, even at $24, okay, and maybe 1 month to go, right, he's not going to exercise on it, right? Because he's already paid 95 cents up front. Even if he does this 1 month earlier, it serves as no benefit to him. Yeah, all right. He might as well just wait and see. Okay, but of course, if Slack goes all the way down to, okay, we touch wood over here, right? If it goes all the way down to $10, and maybe with just 2 weeks to go, right? He may have given up all hope that it will go back above 25. So then he'll start thinking, all right, about actually handing those shares to you. So it all depends on the customer, right, who actually has the stock, right? Do they, feel like they want to give up on the stock? If they do, that's when the assignment could happen, if it's going to happen before expiry. Okay, otherwise, most of these assignments, or 90% of the assignments, actually happens closer to the final 2 weeks of expiry of it. Yeah, all right. Hao Yuan, okay, last question. I'll just break my rules over here and go for last question, all right? Okay, so Hao Yuan basically asks, is interactive brokers, which broker is best for this strategy? Because officially for US brokerages, we have 3 houses or 3 major houses to consider. All right, we have TD Ameritrade, we have Tastyworks, and we have interactive brokers. Okay, now, so if you want to talk about assignment fees, then yes, I would say interactive brokers have the best cost-effective measures because they actually do not charge for option assignments. Okay, TD Ameritrade charges $15 for option assignments, and Tastyworks charges $5 for option assignments. Okay, so from a cost perspective, then interactive brokers will be the most cost-effective. Okay, but if any of you have ever tried interactive brokers platform, which I just had a friend who recently ported his account over, right? You would probably have to take an entire month, right? You take at least 1 month to just get accustomed to that platform. All right, so you have to deem as well, what's more cost-effective. Yeah, okay, what's more cost-effective? Okay, all right, is your time worth more, or is this $5 fee, all right, worth more over here? Okay, right? So, I would say go with a broker that you're comfortable with, okay, rather than focus too much on cost. Okay. All right. Now, I hope I covered most of your questions over here regarding, a really, really interesting strategy and discussion today. Okay, and following our portfolio series, do make sure you join me again tomorrow for day 17. Okay, because today we talk about how you can make some income before buying the stock. Okay, tomorrow we will talk about what happens, okay, after buying the stock. That means if you own a stock or if you sell a put option and you will assign the stock, how can you continue to sell options to generate more income while you wait for the stock to go up? Okay, so tomorrow we're going to cover another one of our portfolio strategy series, the covered call over here for tomorrow's session. Okay, so I'll see all of you again on day 17 at 9 p.m. on live. Okay, thank you very much for joining me again tonight. If you have not done the share over here, do make sure you do so, and we'll post out the downloadable link for the summary for today's strategy. Okay, thank you very much. All right, see you everyone. See you tomorrow. All right, I hope you benefited from the session. All right. Yes, thank you very much, Joshua. Okay, Joshua, get them to join Project Options Cashflow. So let them see it for themselves. Okay, as well, July. Okay, July, get them to come to the live trading sessions that we'll do live. All right, and let them see it for themselves. Okay, and that's when they'll start to understand. Yeah, okay, all right. Thanks very much, Joshua. All right, bye everyone. All right, bye Maureen, bye Shani, bye Christine, bye Zen. All right, bye Jacqueline, bye Uncle Fu. All right, see all of you. Good night. Back to trading. All right, see you. Good night.